Professor Vipin Kumar Agarwal for his endless support and guidance. I also thank and welcome Professor Namita Rajput Ma'am, TIC, Department of Commerce, whose relentless efforts have given this much needed impetus to organizing this lecture series. And once again, I welcome my fellow colleagues and our dear participants. Department of Commerce, Sri Aurobindo College, started a special lecture series on envisioning UN Sustainability Goals 2030 last month, and as another lecture in this direction, our focus today will be on behavioral aspects influencing sustainable financial decisions. Now, I request Namita ma'am to share her words of wisdom before inviting the speaker of today's session. Over to you, ma'am.
Yeah, so a very warm welcome to all the participants from our college and from various higher education institutes. So I will be, giving a very small brief on the topic of today. But before that, I would like to welcome our principal sir, who is here and who is actually very busy and has taken out time to be a part of this, lecture series. So we welcome you, sir. And first,
thank you, Professor Namita. Thank you very much. And thanks for organizing a series of lectures by the Department of Commerce under your leadership.
Yes. So over to you, sir, please.
No, please carry on. Please carry on.
Some motivating words, sir.
Please carry on.
Okay. So basically, the environment around us needs our special attention. So there are about 17 sustainable development goals, and slowly we will try and cover all the different aspects relating to the SDGs, and a special mention on the areas which are connected and very closely related to the higher education institutes. The behavioral finance is specifically an area or a sub-discipline of the behavior economics that examines the real financial behavior and decision making of the people, including the knowledge of psychology and sociology. So this particular session attempts to explore the impact of significant cognitive, psychological, and of course the emotional factors affecting the financial decision making, which could positively affect the sustainable development as the end goal. So the first step towards any direction is awareness, and the second step is acting on it. So in this context, we have a very special, the professor of Sri Aurobindo College Morning, who is instrumental in this and who has actually collated some important facts, important figures, and some special exercises to engage our participants. And of course, this is a wonderful initiative that the professors of our own college are taking this kind of an endeavor of contemplating the factual things together and make a learning a very delightful experience for all of us. So I welcome Tarunika Jain, who's teaching in Department of Commerce and will be delivering a lecture on behavioral finance. So we welcome you, Tarunika, and over to you.
Thank you, ma'am. It is an honor and absolute delight, rather being on the other side, being welcoming by you. And I'm really, really thankful for Principal Sir to join in spite of his busy schedule. Thank you so much. And before I begin, I just want to say that I am just in the beginning of my learning as a learner. And if at all I make any misses during the presentation, kindly forgive me for the same. And I would start the session without any further delay and not keep the behavioral biases away from the human behavior per se. Can I request the host to please allow me to share my screen?
It is enabled from my side. Have you tried sharing?
Yeah, I was just trying it. It shows host disabled participant screen sharing.
Please give it a try now.
I'll do that. Yeah, now it's happening. Thanks. Just a quick confirmation. Is the slide screen visible?
It was visible,
Amita,
but now it is not.
I'll just try once.
It is
visible
there
now,
now.
Tarika. Yes. We can
Right.
see.
Thank you. So on the first slide, so this is basically how I understand why this series is so important. Because in theory, when we read in our classrooms and we study, the theory and the practice are the same. We kind of teach what we are trying to practice. But when we go out in the real world and in practice, they are not. There is a difference between the theory, the theoretical knowledge that we have, and what we actually exhibit in practice in the practical real world. So today's session is going to be about the behavioral biases. And as you can see, there is a range of emotions depicted on this slide. And I am sure some of us experience several of these during the day. At times we are happy, sad, frustrated, angry, or maybe just confused. And trust me, more often than we think, these behavioral aspects, they influence our decision making. And my area or my predominant area where I work is finance. So in this session, I'm going to translate, or my attempt is to figure out how these behavioral biases impact our financial decision making. So to begin with, I just have a very small graph. This is a graph of Sensex, which is a sensitive index, the stock market. And this ranges from January 2020 to January 2021. If you follow my pointer, this is a point when the Janta curfew and the lockdown was announced and the market tanked. Or यहाँ पर market गिरने के बाद, the question that I want to ask everybody, कितने लोगों ने सोचा कि अपना equity mutual fund को बेच देना चाहिए? So how many of you actually thought of selling your stake in the market, right? So, I mean, it will be great if we can get some answers in the chat box. That will be nice to engage ourselves, or maybe you can keep the answers to yourself and then analyze it later. And then what about this point, which is here at the peak, end of 2021, beginning of 2021? How many of us actually thought that ki aur kharidna chahiye the equity mutual fund and we should be buying more and more? Right? So I am not asking you to answer me right now, but just think about this situation as an investor. जब market गिरती है, हम कितना उसमें पैसा invest करना चाहते हैं या पैसा अपने investments को liquidate करना चाहते हैं. And when markets are at the peak, which is around about January 2021, the time period shown, how many of us are willing or are comfortable to increase our stake and buy? Why do we do that? We all know that we should buy at a lower price. We should sell when the prices are higher to benefit from our investment decision. In spite of that, we do this. And let me tell you, the answers are that we believe that we are rational, but investors are not totally rational. We are human beings and behavior is intrinsic to all of us. We often act based on imperfect information. And this imperfect information results in buying stocks maybe on, hunches or those media tips. And thus all of this put together leads you to make a non-rational decision. And these non-rational decisions actually can be predicted. As ma'am rightly said, being aware is the first step. So if we are aware that what possibly errors we can make while deciding, maybe we can make lesser number of errors the next time. So this is where how I want to link the behavioral management to the financial management that we all have. And this is a study, this is a report which has been published, which says that when you are managing your investments as an investor, finance or investment की knowledge 4% ही सिर्फ काम आती है. बाकी जो स्टॉक मार्केट में पैसा बनाने के लिए काम आता है, वो सब हमारा बिहेवियर मैनेजमेंट होता है. What sort of emotions do we have? How do we react? How fearful are we? How greedy are we? How do we communicate? हमारा ऑप्टिमिज्म और पेसिमिज्म लेवल कैसा है एक टाइम पर, उन सब चीजों से हमारा फाइनेंशियल प्लानिंग, बिहेवियरल मैनेजमेंट, सारी चीजों पे असर पड़ता है. And this is exactly what this slide illuminates, right? As an advisor, as a person who's managing your own finances. So, my dear friends, I think we need to manage our behavior more than managing our portfolio. So let's see what is the basic difference of traditional finance that we have been studying till now and that we are teaching in our classes versus the behavioral finance. So given that we all know what is traditional starts with the assumption we are rational investors. रैशनल इन्वेस्टर्स, हम सबको रिस्क ना पसंद है, हम सबको रिटर्न सबसे ज्यादा पसंद है. जितना रिटर्न मिले उतना बेटर है, कम से कम रिस्क पे मिले और भी अच्छा है. All the things that we do, something like efficient market hypothesis, the portfolio theory, which revolves around CAPM, standard deviation, all of these theories, the first assumption is rational investors, right? All of this traditional finance actually tells us what? How the investors should react, how the markets should be, right? So it is more of an idealistic situation that traditional finance gives us. What about behavioral? Behavioral tells us how people actually are. What do they actually do? How do they decide? So it attempts to describe how the world functions. It functions with greed and fear. Some people are greedy while others are fearful. It functions, the stock market or our investment decisions functions based on our optimism, our pessimism. And the default theories that have been in place in the finance literature per se. So the pioneering theory was the prospect theory. Then they have illustrated the disposition effect. And then there are several other biases, n number of them in due course of time. So we will try and go through each one of them and understand how these biases reflect in our decision making, right? So let's move forward and understand that there can be two types of biases. One is a cognitive bias and the other is a behavioral bias. So cognitive bias means the information that we've received is correct. जो सामने से information आ रही है वो तो सही है, but जब हम उसे process कर रहे हैं उसमें reasoning गलत है. Whereas when we talk about an emotional bias, this means that as soon as we are presented with some information, हम impulsive काम करते हैं. So I am sure we have in the audience n number of people who are guilty for emotional eating, where people eat chocolates to feel good about themselves, or retail therapy, when we end up shopping a lot just to be happy and to feel good about a certain situation. These are all our emotional biases, right? Where we are not able to control our own emotions. So cognitive bias, faulty reasoning, and emotional bias is all about the impulsive behavior that we do rather than on the analysis, calculations, and all of this. So here is a quick slide where I'm trying to enumerate the effects and the biases that we will be discussing. The first one is the prospect theory, which explains the disposition effect. Then we have herding effect, confirmation bias, under and overreaction when we have the familiarity bias, and I'm just naming them right now, and of course I'll be able to explain them better. For framing, the decoy effect, how we as investors are falling prey to mental accounting, or survivorship bias, or the gambler's fallacy. So my attempt here is just to kind of illustrate each one of them. Let's begin with the basic decision that I would want all of you to make. So here is a question in front of you on the screen where I want you to kind of decide. If you can reflect it in the chat box, it will be great, that which one of the options would you prefer? Would you prefer a sure gain of rupees 250, or would you prefer a gain of rupees 1000 with a probability of 25%? So what do you prefer, a sure gain or option B, which is a gain of rupees 1000 with a 25% probability? So I can see in the chat box, everybody is saying sure gain, which is yes, everybody likes gain and we are making rational choices. Wonderful. So before I move next, I would also kind of present another question. And the another question is this. I'll just read it out for you. So this means that now you have to make a choice where you have a sure loss of rupees 750, or there is a 7 name it as option A and B, and this is option B. So this is A, and let's say this is B. What do you prefer, A or B? And please read it. It's talking about a sure loss, right? So, okay, I can see again a lot of responses, and if I am right, majority, rather maybe 100%, they say B. There's a 75% chance to lose rupees 1000. Okay, are you ready to listen to what I have to say? Here, I just have to tell you something, that the first two questions where the choice was between a sure gain, everybody chose sure gain, right? We were exhibiting risk aversion. Risk aversion is where we dislike risk and we want minimum risk. Risk averse investors, right? So risk aversion is हमें risk नहीं पसंद है, तो sure gain is what we like. But in the second case, when we were talking about a loss, most of you, or rather 99%, had a choice of 75% chance of losing rupees 1000. Now, losing rupees 1000 with a 75% chance is a reflection of a risk-seeking behavior. And what do we mean by risk-seeking? Risk-seeking means we are willing to undertake more risk. And Ashitu Bhatia, let me tell you, both are not the same. They don't mean the same thing. It might look like it's the same, but when we put the probabilities to these future events, right, there is a greater chance of losing rupees 1000, higher monetary loss. So this is the difference. This is exactly what prospect theory showed, that people are not always risk averse. Investors are not risk averse. They are risk averse and they are risk seeking depending on the nature of the prospect. Here, the nature of the prospect is whether it is a gain or a loss that one has to decide. Traditional theory always assumes risk averse investors. And that is what the cornerstone of behavioral finance is, that risk averse investors are not always the same. They make a choice every time. Now, with this, maybe I've set you, some of you thinking, but let me go to another question. And again, I would request you to make a choice. So here also, I have given you two different prospects. The first one here, if you follow my laser pointer, this says choose between the two prospects, which is 0.1% chance of winning rupees 50,000. And the other is 100% assurance, right, of winning rupees 50. What do we choose? So right now, I would request everybody to please focus here. This. So 0.1% chance of winning rupees 50,000 and 100% assurance of winning rupees 50. So I can again see people saying option A, yes, right. Why do we do that? Does it sound like lottery? Right? This does sound like lottery. So lottery का ticket खरीदते हैं where the winning amount is 50,000, but जितने लोगों ने लिया है किसी एक को lottery लगेगी. This is explained as lottery effect in the finance literature as well. And again, let me tell you, when we say that we like the option A better, we are actually kind of overweighing this probability. Overweighing means हम ज्यादा ऑप्टिमिस्टिक हैं कि वो जो 0.1% चांस है वो हमारा ही है, rather than, and we are ready to forego this 100% of 50 rupees that we are getting. Ultimately, they both are the same in terms of the payoff. 50 rupees is what the net payoff is. But हम risk किस में ज्यादा ले रहे हैं? Uncertainty किस में ज्यादा है? Option A में. So this is your risk seeking, right? And similarly, if we go to this another prospect here, choose between the two prospects. 0.1% chance of losing rupees 50,000, 100% assurance of losing rupees 50. What is it that we would choose? Option A, 0.1% chance of losing rupees 50,000 or 100% assurance of losing rupees 50. And trust me, there are no calculations or there are no right and wrong answers to this. You just have to follow your instincts and be true to yourself. What would you choose? So I'm looking at the chat box. I'm getting a couple of responses as B. I would request everybody to kind of just put in these answers in the chat box. Let's make it a little more engaging. So I can see, but still there are answers except for maybe one or two options, which are A. Everybody else says 100% chance of losing rupees 50. And what is the reason for that? Again, if we have to think, this is risk aversion. Yes. If we have even slightest chance of losing rupees 50,000, we don't want that. We are risk averse. So again, depending on what is the prospect that you are seeing, whether it is a lottery-like phenomena or it is like an insurance-like phenomena, right? We are changing our stance from a risk-averse investor to a risk-seeking investor and vice versa, right? If I tell you in the financial decisions that you make, this 100% assurance of losing rupees 50 can actually be understood like the premium that you pay for term insurance. India में लोग insurance बहुत कम लेते हैं. Why is that? Because लोगों को लगता है वो पैसा तो बेकार हो गया जो premium में दिया है. You are not going to get that benefit. Obviously, nobody wishes to die just to get that insurance cover, right? So 100% assurance of losing rupees 50, we are risk averse. This is primarily the reason why we take insurance. So the behavioral finance, the prospect theory, it states very simple things that the investor behavior changes when they are presented with gains or losses. So jab gains aayega, so it might be risk averse, risk seeker. And similarly, if you present the same investor with a loss type situation, he may behave differently, and therefore you cannot for sure assume always that it is going to be a risk averse investor as we do in the traditional theory, right? I hope everybody is able to, kind of enjoy this and reflect on what is being discussed. Here comes another impact or another effect. And this might seem familiar also. So let's talk about the first effect, which is the house money effect. And this is an impact this is an effect which we see in the investor behavior when you have a situation of prior gain or a prior loss. So remember the graph that we were seeing in the beginning? So when we are sitting on losses, our decision making or the decision process is different. And when we are sitting on gains, हमारा कुछ फायदा हुआ है और उसके बाद हमें कुछ financial decisions बनाने हैं, the thought process will be a little more different. Now these are the two impacts that we are going to study. So house money effect. So after a prior gain, so let's say you made 1,000 rupees in the stock market. Lagaya, beginner's luck hua, 1,000 rupees is what we are, won. And this typically we see in, the young blood or the young investors. So beginner's luck, shuru mein fayda hua. Do you think people will become more and more willing to invest in the stock market? or be willing to trade? Yes, because if you have experienced success once, you tend to feel that yes, let's do it again. So जब एक बार फायदा होता है, then people are more open to assuming risk. And this is one thing, let's establish that every time we trade, we are undertaking a risk, because there can always be two situations, either a gain or a loss, right? So every time we trade, we are taking a risk, but after a prior gain, when you've made some money, you will be more open to trade, you will be more open to assuming risk. Whereas what can happen in the case of a loss? Think about it, when you've already incurred a loss. So market gir gaya hai, you are sitting on a loss of, let's say, 10,000 rupees. What would you do? Would you again trade more, or would you trade less? Now the answers again can be mixed. If you trade more, then you are actually thinking that let me average, right? This is something which is known as averaging karna, rupee cost averaging. तो पहले 40 में जोमेटो का शेयर खरीदा था, अब 20 पे आ गया तो और खरीद लेते हैं, एवरेज प्राइस बीच में आ जाएगा और कम हो जाएगा, तो जब बढ़ेगा तो आई कैन सेल इट, राइट? सो रूपी कॉस्ट एवरेजिंग इज व्हाट हैपेंस व्हेन यू वांट टू break even. So you've incurred a loss, you want to break even, so you end up buying more and more so as to average it. The other impact can be, let's say I trade in a derivative segment और मैंने F&O में बहुत नुकसान हो गया मुझे, and then I was like, okay fine, I am never going to enter into this segment again. This is a snake bit effect. The name itself is very clear. एक बार ही सांप ने काटा, दोबारा नहीं जाएंगे उस जगह पे. So you become more risk averse. So there can be two things depending on whether you have a prior gain experience or you have a prior loss experience, and this is what is going to change every time, right? So these are the two different types of effects that can possibly happen based on what and how you are dealing with. Now let's do an example of this particular situation and see what decisions do we make as investors. So here is a situation that I've given you on the slide in front of you. Let me just go through this. And meanwhile, I request everybody to read it and kind of make a choice on their own. What do we want? Option A or option B? So the situation here is that you've bought 100 shares of company ABC for rupees 40 per share. So that means you have a total investment of 4,000. In the following trading period, which can be probably the next day, the share prices increased by 15%. So that means the share price from 40 to it became 46. Now, as an investor, what would you do? You have two choices. First is that you will immediately sell your investment with a position of gain of 15% and realize those gains. So 40 का 46 हुआ, बेच दिया और अपना gain realize कर दिया. Option B, which is a risky option, you will keep your position with one more trading day, where again there is a possibility share price 15% से बढ़ सकता है, which is 252 rupees, or it can go back to 40 rupees, right? Now, in this given situation, don the hat of an investor, think about it, what would you do? Will you sell it, which is option A? Would you keep it, which is option B? And trust me, there are no right and wrong answers. That is why stock market is one place where two people think exactly the opposite. One buys, the other sells, and both are correct. Right? This is just to understand our risk, attitude, aptitude, and preference. So interestingly, yes, I can see everybody is, I have a mix of answers. Somebody says A, somebody is saying B, and equally divided is the group, right? Second option as an investor. Okay. So there is a qualifying option as well. What is the difference here? So here that we are sitting on a position of a gain, right? So I told you that we are in a position of a gain. And now when you have to make this decision, right? What do we do? We have this tendency to sell winners. Okay. So people who said option A, you are exhibiting disposition effect. This disposition effect is nothing, which just means that we are selling winners, right? We prefer the gains which are coming to us. If we go further, right, and let's flip the situation. Rather than sitting on the prior gain, let's make a loss of 15%. So here you bought the same share for 40 rupees, but now the share price is going to 34. It has declined. Now what do? We immediately sell the share at a loss of 15%, or we keep it another day in the hope that it is going to jump back to 40. What do? Option A, option B. Sorry. Okay, so I'm having answers where option B is clearly the preferred choice. What about others? Option A and option B. Okay, perfect. Again, mixed, and that's absolutely fine, right? Now, what does this disposition effect says? The disposition effect says that if you have a superior performing stock, which this superior performing stock was the one which has a gain, you will prefer to sell it too early. That means you would just want to realize that gain of 15%. 40 का 46 हुआ, बेच के निकल लो. पर यही अगर स्टॉक में लॉस है, which was the second case here, which is 40 to 34 हुआ, there were more people who were opting for option B, that they will prefer to hold it on. And why is that? Because we as investors are more risk averse when we are in the case of losses rather than the gains. So whenever we are faced with prior losses, we are more risk averse. And this risk averse nature is depicted, right? Is actually depicted through the examples that we've just discussed. And there is nothing right or wrong. We are just investors who have different types of biases. So this line here, which says tendency to sell winners and hold losers, is the main line of disposition effect. So if somebody wants to understand, so like prospect theory says investors are not always risk averse. Disposition effect says you tend to sell winners and hold losers. These were probably the two technical ones. Now what we go is very, very simple. So there is something which is known as herding effect. Herding effect is, so we've always seen a herd of sheep or a herd of cows, which is bheed. We as human beings, again, we find comfort when we are large in number, majority, right? So people are influenced by each other, and we seek unconsciously that crowd is right. And this is where this statement, which is wise crowds become foolish, is very, very true, especially in the stock market. There's a very famous quote which says, when the shoe shiner starts giving you stock market tips, it's the time to exit the market. Why? Because it's the herding behavior. In the herding behavior, you are not analyzing, you are just falling prey to this information. This is a term, again, very, very established and popular, which is known as infodemic, like the pandemic of information, right? So much of information which might be irrelevant, which might be unreliable, social media, but we still fall prey to that, and that always happens subconsciously. So this herding effect is another one. Moving forward, there is also something known as confirmation bias. Confirmation bias means that the way the information is presented, and when we have information to be absorbed, we have a tendency to interpret these new evidence as per our convenience. If it suits my belief, I agree to that. Something which is contradictory to my belief, I will undervalue that information, right? So we as people, we as investors, we generally look for supporting evidence, and we disregard any contradictory evidence. Again, let me just give you an example of the same, and let's see how well we do in terms of a framing bias also, right? This confirmation bias also results in the under and the overreaction, by the way. But let's look at this. Okay, first let's look at this here. This is the image. There are two types of frozen yogurts here. One which says contains 20% fat, and the other says it is a frozen yogurt which is 80% fat free. If you go to the supermarket, what is it that you are going to choose? So quickly, what do you choose? Contains 20% fat or option B, 80% fat free? So 80% fat free. Okay, okay. Do you think, is there any tangible difference in the content, by the way? Right? So 80% fat free means there is 20% fat. But the way the information is presented to us, the way the packaging is done, the way the information is stated, we are tempted to go for one particular packaging rather than the other. We are tempted to go towards one particular brand, right? Both are the same. There is no difference. Absolutely right. Let's come here. And if you follow my pointer, the first line is longer than the second line, or the second line is longer than the first line. So you need to tell me in the chat box which line is longer, first or second. So which line is longer, the first or second? Okay, I have a very intelligent participation here. They both know that the lines are equal, but B is looking bigger, longer, right? Absolutely right. So the lines actually are the same, and it is a very, very popular Miller-Lyer illusion where the lines are actually of the same length. It's only with this particular part of the line, the direction of that arrow which differs, and it makes the B look longer, right? And now let's come to something which we generally have always been hearing from all those TEDx talks, that the glass is always half full, half empty. You should always look at the full side of it. But does it actually make a difference? So if I say this is 66% empty or this is 33% full, they both mean the same, but we are tempted by, when we are impacted, or the information is presented in a certain way, our decisions are impacted. So this is what these allusions or these illustrations help you to see, that there can be a framing bias. Now let me just go to this. And here is a situation from a public policy. So we were recently impacted by COVID, and let's say, so India is preparing for that. It is going to kill 600 people. And the doctors have proposed, there are two programs. And the two programs is program A, if it is accepted, then 200 people will be saved. If program B is accepted, then there is 1/3 probability that everybody will be saved, and 2/3 probability that no one will be saved. Which program are you going to select? So as a public policy decision maker, you need to make a choice between A and B. What do you choose? Between A and B, what do you think? Oh, I have options from B as well. Okay, what about others? A or B? B. Okay, great. So I think we've got the hang of this exercise. If program A is accepted, 200 people will be saved. When I say I accept program A, I am again exhibiting the risk-averse nature given the framing bias, right? Both are technically the same. In both the cases, the end result is going to be the same. It just, is asking you based on how the information is presented. So this was a survival frame where the tendency can be to select one. If we are looking at the losses frame, right? Again, the same situation, two programs. Program C is accepted, 400 people will die. If program D is accepted, 1/3 probability, no one will die. 2/3 probability, 600 people will die. Which program will we select? Where 400 people are dying, or program D, where there is a different probability? So I would again request to make choices, and these choices are not something which is to be done after careful analysis. This is just an exercise to, inquisitiveness and the instinctive behavior. Okay, option A, great, wow. So what this framing problem says, so right now I do realize that I've activated both the right and the left side of the brain of my participants. But what does this framing exercise say? That if majority choose program A, they are exhibiting risk averse. Why do we say risk averse? Because we are starting with a situation of full mortality. Everybody is going to die. And then we are moving towards partial survival. Right? So this is a survival frame. We are going from extreme negative to the positive. Whereas in the mortality frame, if we look into it, we are starting from full survival, right? And then going towards partial mortality. So these are these different frames which kind of tell you that the framing, how the information is presented, right, can influence the decisions. And these decisions then can be inconsistent. And these inconsistent decisions result into irrational behavior of people at times. And these behaviors can be exhibited anywhere and everywhere. Right? So, let me just clarify. I thought I should have done this earlier. All of these exercises and questions, they are well established in the finance literature. There's not even one question that I've created myself. I am not the creator of these questions. These situations have been tested in a form of experiments over the years, and experiments have been done. Okay, quick answer without too much of calculation, right? What will be the quick estimate for the product of the 8 numbers that are shown below? 1 into 2 into 3 into 4 into 5 into 6 into 7 into 8. What is the answer? Option A, B, C, D. Quick. I don't want correct answers here. I just want what is the first instinctive answer that you would choose. So between around 1,000, around 500, what do you think the number will be? Around 10,000, what do you think the final number would be after multiplying all these numbers together? Or it will be around 40,000 something. Closest answer. It has to be just an approximation. What is the closest proximate? Right? So the correct answer here, if I have to tell you, the correct answer here is 40,320. Okay. Now, after calculating, we can all go there. What does it show? Why would you not go to point D straight away in the first 30 seconds or so? Because when we start from these smaller numbers, right, our mind processes this information at least for the first 4 numbers. So you go into 1 into 2, 2, 2 into 3, 6, 6 into 4, 24, 24 into 5 also. But beyond that, you stop calculating and you go into the cognitive bias zone. So this is why, and if the other way, which is in the experiment, the other way is when we just flip these numbers. So if I give you a number which is 8 into 7 into 6 into 5, your answer will always be higher than this one. Whatever be your answer will always be higher than this one. So this was just another, right? Where how do we start the information? How do we process the information when we are absorbing it is an indication. Now, this is very interesting. One of my favorites, which I have been using as a child quite often. We go to a supermarket. There is a thing that I want to buy. There are 2 bottles, let's say, of perfumes. One is $10. The other is $30. I feel $30 is very expensive. And suddenly the shopkeeper comes and keeps the 3rd bottle, which is $50. And I suddenly start feeling, oh, that's okay. $30 is reasonable. It's somewhere in the middle and I can go and buy and, end up buying it. This is what is called as the decoy price. Decoy, which has no reasonable relationship or no reasonable meaning to influence this decision making of buying a $30, product. But just because you are, visualizing something as a more rational, reasonable choice, you end up buying that. So this is another which is called as decoy effect. So where the information is presented in a certain manner, that one which was looking expensive a couple of minutes back starts looking reasonable. Now let's go to mental accounting bias. How many of us have heard about, the KBC winners, jo kaun banega karodpati, where they become karodpati and then in 1 year they become rodpati again, because they are not able to manage, the money that they've done from the gain. Whereas these are the people who would strive the entire life and still not make 1 crore of rupees as a livelihood. This is precisely because the mental accounting bias. Mental accounting means that when I receive money, which is like from a lottery, and when I earn the money, which is like maybe a salary, I treat both of them differently, right? What I earn from my salary, I may be more, conservative in my approach when I have to invest it. But when I get something, maybe, it is passed on from the generations, or it is from a lottery, or it is a capital gain, you start treating that money in an illogical manner. And people have done that. And there is ample evidence in the literature where people have seen that you have a higher risk appetite with the money that you receive in the lottery. Again, this is not right. Money is money. The value of that 100 rupees is going to be the same, whether you are earning it from salary or you are getting it from a lottery. But this bias ends up treating, making you treat both of these money differently. So the next one that I have is a familiarity bias. Again, this bias is very well studied in the finance literature. When you invest only in your own company or in your own country, because these are the things that are familiar to you. This is called as familiarity bias. And in the finance literature, I have my friends and my senior colleagues also. There is a term which is known as home bias. Home bias is a observed phenomena where domestic investors prefer domestic stocks. So a US investor would prefer a stock in US economy. An Indian investor would prefer a stock in the Indian economy. And they get all that comfort, from the same cultural setting, same legal rules, informational advantage. And that is what leads to familiarity bias, right? So in spite of so many international mutual funds giving an option for you all to invest abroad, as a percentage of the total Indian investor population, the number is still very low.
Hello.
And the reason is investor bias, right? Now, that is where, I come to another one, which is called as survivorship bias. And that probably will be the last one, I think, which we can discuss right now, because there's paucity of time. So survivorship bias, we all have faced through that. So this is something where, we see that one person on the top, and we feel that if they have done it, anybody can do it. And that person also likes to propagate that. If I can do it, anybody can. But remember, this is a pyramid. There's a lot of failures in the bottom, which is 99.9%, who have failed. And there is this 0.1% who have succeeded. So this survivorship bias is actually a phenomena which manifests itself into a distorted reality and a distorted interpretation, right? Where we feel that, okay, fine, college dropouts like, Facebook, Google, WhatsApp, everybody, if they can do it, I can do too. But then you overestimate the odds of success, which is overweighing the probability. And that is where your survivorship bias comes in. When we see the index automatically, the stock market index, it automatically filters the weak stocks every time it rebalances. There is a survivorship bias there as well. Why? Because we are only considering these surviving observations. We are not looking at things which have failed, right? So a stupid decision that works out well becomes a brilliant one in hindsight. That is one of my favorite quotes, which I have often seen being applied in real life as well. So, I mean, there was a decision which might not have been that great, But because of the conspiracy of the entire, situations, good luck, everything, it turned out to be a brilliant one. So Bill Gates, Mark Zuckerberg, they became millionaires, right? Millionaires, and they are successful. But what is the percentage that you are going to be one? So it might look as a brilliant one in hindsight, but we need to examine what is that probability of loss. And this similar thing, right? This similar phenomena should be done every time when we are investing in the stock market. Why? Because once we are aware about our risk-averse, risk-seeking behavior, the differences and the divergent behavior that we have, we will be able to, kind of avoid these fallacies. And next time we will not complain. Market गिरी थी तब नहीं खरीदा, अब जब market चढ़ रही है तब खरीद रहे हैं closer to the 52-week high. You will be able to benefit from making knowledgeable, educated investment decisions by just, managing the behavior. So I think that is where I would end. And if there are any questions, and first of all, I apologize if there was any misses that I made during the presentation. But one more, just last bit. Anybody who would, who found this topic interesting and wants to read more about this, these are 2 books, which is here, Thinking Fast and Slow by Daniel Kahneman, and Fooled by Randomness by Taleb. They are the ones which I have read and gained and understood whatever little I have understood of behavioral finance. Everybody feels free to read for that as well. Thank you so much. Thank you, ma'am. Thank you, sir. Thank you, everybody. Ma'am, आप mute पे हैं.
Yes, I congratulate Tarunika for such a wonderful lecture. And, we have actually learned, although my area is also finance, but, having this kind of an insight was actually because we are too busy in taking the other subjects, and, this subject is lagged behind, because unless and until you research in a particular area, the contemporary issues are missing. So, this kind of lecture series, what Shri Aurobindo College Morning has started, is an excellent endeavor in the knowledge sharing platform, and all the more in the new education policy. If you talk about, we should add different flowers to a bouquet to make it more beautiful. So that's what we are doing, and we are on to the innovative teaching pedagogies also, wherein a combined programs are conducted by our college, which is the student development as well as the faculty development programs. So it's a win-win situation for all of us, and we welcome such initiatives, and my heartiest congratulations and kudos to Tarunika for such a wonderful presentations. Thank you so much. So on to Shasta, please.
Thank you so much, ma'am.
Thank you, ma'am. Thank you, Dr. Tarunika Jain, for such a wonderful presentation. I need not say anything. The chat box is full of congratulatory messages. And trust me, you totally bowled it. And I was just speechless to see your presentation going, and so many concepts, so many biases, everything, every decision, every emotion that we are exposed to in the investing world. You explained everything so beautifully in such an explanatory way. And it was so difficult to actually write down the report for this session because I was totally captivated in your session. So I have given a few misses in the report as well because I was totally into your presentation, and that testifies how wonderful it was.
On to our
thank you so much. And coming to our organizing team and Sir Principal, Sir Professor Vipin Kumar Agrawal, sir, thank you for being the pillar of strength for all these sessions. Without your support and guidance, we would never be able to execute these
Shasta, just for a minute or so, I would like to congratulate Department of Commerce and the teacher in charge, Dr. Namita, for organizing this lecture series. And I must say that this lecture was really very informative for me, at least, in the sense that this topic is quite close to my heart. And I've been teaching in the past the fundamental of investment paper. And every time in the classrooms, we teach technical analysis, fundamental analysis, but practically nobody talks about the behavioral aspect of the finance. And as Dr. Tarunika said, 7% of the people, 7% is only the smartness in the sense fundamental and technical. rest all is behavioral aspect. And I do tell you that in my own experience also, because part of the, frankly speaking, part of my saving, I do invest, I do park in the mutual funds and these SIPs. So when this COVID came, I stopped my SIPs because I thought this is my hard-earned money, and this hard-earned money, I can't lose more because I have whatever the little saving I do have, I do park that. And this is what practically happens. Had I that time kept my SIPs, the return would have been 35% to 40%, even higher. I'm telling you the conservative figure. So this topic which Department of Commerce and Dr. Tarunika has chosen is really very important, and all the students, the faculty, and even the general public in general, in the sense those who have savings, that they must learn the behavioral aspect of the finance. So for that matter, I would like to congratulate Dr. Tarunika, and I will discuss some time with her. I will take a class from her on this very topic, on the behavioral aspect. I'm sure.
Your presence and the presence of all the senior teachers, I mean, my teachers as well, I should say, and all my fellow colleagues have motivated me. I can't tell you how honored and how good I feel about it right now. You were
So,
through the
congratulations to Dr. Tarunika for a wonderful lecture, and congratulations Department of Commerce.
Thank
And
you
the
so
teacher in
much.
charge and all the team, the organizing team. I can see the organizing team. I'm not naming people, but I must thank all of them on behalf of the college and on my personal behalf. Thank you very much.
And thank you, Namita ma'am, for making us work on these initiatives. And this is certainly helping all of us a lot. And I would really encourage Tarunika ma'am to take online classes so that we all can join for future lessons. It was truly amazing. Thank you.
Important takeaways to our participants. So please share your presentation to all of us so that we are all, having that takeaways, because, when we join any kind of a faculty development program or anything, so we always look for some good takeaways. So the things which we have missed and slipped, so we can, catch up again. So please share the presentation in the chat box to all of us. And we have the email IDs of all the participants, so we can share them on the email IDs. Thank you so much, everyone, for being a part of this wonderful lecture. Thank you so much. So we end the meeting. Thank you.